What if I told you there's a trading strategy for the S&P 500 that, for the last 30 years, has won on more than 7 out of every 10 trades? I know, it sounds a little too good to be true, right? Well, today we're going to break that exact system down, piece by piece, figure out how it works, and most importantly, find the catch. Okay, let's dig in.
Here it is, 72.44%. Just let that number sink in for a second. We're talking about 3 decades of market chaos, the dot-com bust 2008, the COVID crash, you name it, and through all of that, nearly 3 out of every 4 trades were winners. In a market as tough as the S&P 500, it's a pretty staggering number.
And what's really wild is that the win rate is just the start. Check out the other numbers here. We've got a profit factor of 1.67, which means for every single dollar it lost, it made back $1.67. It did this over more than 1,100 trades, and it grew the initial capital by 24 times. But here's the real kicker. This was all done without a single drop of leverage.
So I know what you're probably thinking. The engine behind numbers like these must be some kind of hyper-complex, PhD-level algorithm, right? Well, that's the first big surprise. The rules are shockingly simple. But actually following them, well, that takes a kind of discipline that is anything but.
The whole philosophy is incredibly straightforward. You only bet on growth. You never, ever short the market. The thinking is pretty simple. The US stock market, over the long haul, wants to go up. So instead of trying to be a hero and call the top, this strategy is built to do one thing and one thing only: take advantage of the market's tendency to violently snap back after a sudden, fearful drop. You just ride the main current and use the dips as your entry points.
So how does it spot those dips? It all comes down to one single indicator, the Money Flow Index, or MFI. You can think of it like the classic RSI, but with a crucial upgrade. It also factors in trading volume, which gives you a much better feel for the actual buying and selling pressure. But here's the real secret sauce. The period is set to 1. This means it's not looking back 2 weeks like most indicators. It's only looking at today. It's hypersensitive, designed to catch those immediate, knee-jerk emotional reactions in the market. With that ultra-sensitive setup, the entry rule is ridiculously simple. You buy when the MFI value drops below 5. That's it. Full stop. See, this isn't just about buying when people are a little scared. This is about buying when there is absolute, volume-driven panic in the streets. The signal is designed to pinpoint that exact moment of overreaction where a bounce back isn't just possible, it's statistically probable. The exit is just as mechanical, but it requires 2 things to happen at the exact same time. First, today's closing price has to be higher than all of yesterday's price action, a real sign of strong momentum. And second, the MFI has to be screaming hot, above 95. That combination tells you that the fear-driven bounce is probably over, and it's time to sell into that final euphoric gas before the move completely exhausts itself. And now, we get to the part that goes against every single instinct a trader has. The system has no stop-loss, no preset take-profit targets. You get an entry signal, you buy. You get an exit signal, you sell. Period. There is zero room for your feelings, your opinions, or your gut instincts. This is the absolute core of the strategy, and honestly, it's what makes it so psychologically brutal to trade. So, we have these simple but tough-to-follow rules. The big question is, do the results actually justify the nerves of steel it would take to execute this? Let's see how this thing actually held up when stress-tested against decades of real-world market chaos. Okay, this is fascinating. Just look at its performance during some of the worst market downturns. In the 2022 bear market, the S&P fell almost 20%. This strategy was up 4%. During the COVID crash in 2020, it posted an 18% gain. See, the strategy doesn't have a crystal ball. It just mechanically reacts to the emotional extremes of right now. And this chart, wow, this really tells the long-term story. That green line is the strategy's equity curve. It turned 10 grand in 1993 into over $240,000. You can see how, over the long run, it has crushed the simple buy and hold blue line. And this is a huge but. You can also see those terrifying, gut-wrenching drops along the way. And that brings us to, without a doubt, the most important part of this whole analysis. Those incredible returns, that 72% win rate, they do not come for free. In trading, there is always a price to pay for performance. There's always a catch. So what is it? What's the hidden cost of a system that wins this often? This number, right here,
negative 32.43%. This is the maximum historical drawdown, and it is by far the most critical number you need to burn into your brain before even thinking about a strategy like this.
Let me be crystal clear about what this means. At one point, if you were trading this system, you had to sit there and watch your account bleed out by nearly a third from its all-time high. Just imagine watching a $100,000 account shrink to $68,000, all while the rules are screaming at you to do nothing and just hold on. That is a brutal, brutal test of anyone's nerve. And if you're thinking, hey, I can just improve this with a little leverage, please, just don't. With just 2x leverage, that incredibly painful but survivable 32% drawdown instantly turns into a catastrophic 64% loss. 2/3 of your account, just gone. This strategy and leverage absolutely do not mix.
So here's the bottom line. The success of a mechanical system like this has very little to do with the code, and everything to do with the psychology of the person clicking the buttons. The real challenge isn't beating the market, it's beating that quick money mind virus in your own head.
But look, don't just take my word for any of this. The creator made the code public for a reason. You can, and you absolutely should, go verify all of these results for yourself. It literally takes 4 simple steps in TradingView to run the exact same 30-year backtest and see these numbers with your own eyes.
And this, right here, is the fundamental conflict, the real tug of war. On one side, you have the strategy. It's just simple code. It's mechanical, and it's statistically proven over decades. On the other side, you have the trader, a human being full of fear and greed whose every instinct is screaming to sell at the bottom during a 30% drawdown. A statistically perfect strategy is completely useless if your own psychology cracks under the pressure.
I think this quote from the source material just nails the entire ethos of this system. It doesn't try to predict anything. It's built on a simple reactive logic that has, over the long haul, proven to be more powerful than trying to guess what's going to happen next.
Which really leaves all of us with a final, provocative question to ask ourselves. We all chase the systems with the fanciest backtests and the highest returns, but maybe we're all asking the wrong question. Maybe the best strategy isn't the one that looks the best on paper, but the one whose rules you can actually, truly follow, especially when it hurts the most.